What's going on, people? Luke here from LAGFX. We're back today with another episode on how to create a comprehensive trading plan. This is actually part 2 of entry and exit criteria. Entry criteria is quite a long video, so I wanted to split it into 2 videos. This should have been uploaded on the same day as entry criteria, just so you guys have access to both videos at once. But in today's video, we're just going to be touching base on exit criteria. I don't plan on this video being too long, but I just want to cover the topics that I've listed below in enough detail for you guys to get a good understanding on some of the things that we should be looking at when it comes to closing positions off in the forex markets. If you guys do go on to enjoy this video, don't forget to leave it a thumbs up. All the support you guys provide is very much appreciated. If there is anything within this video that you want me to touch base on further, go into more depth, then leave them in the comments below, and I'm more than happy to create another video based on that subject. And if you guys aren't involved in our VIP services or the Learning Lounge group chat, get yourself involved. The links will be in the description. Now, as mentioned, we are going to be touching base on exit criteria. So the things that we're going to be looking at are where we place our stop loss and take profit orders. We kind of touch base on that on the entry criteria video, but we'll just go over that topic again in this video, maybe in more depth. We'll look at trailing stop losses, so where we should be trailing our stop loss, when and where. The reassessment of market conditions, so based on fundamental news coming out, or the fact that maybe a trade that we have placed is no longer trading in our favor, how we would look at managing the position. News and events, so again, focusing on fundamentals. If fundamentals were to hit, or if fundamentals were due out, what precautions would be put in place to ensure that we don't lose on the position that we're placing, or we don't take too much of a loss in the position we are placing. And then exit based on strategy rules. So if the trade was going against us and we thought that our stop loss was capable of being hit, when and where should we, take the loss and close the position early. Now, when it comes to stop loss and take profit orders, I place these orders in areas of significance, areas that have meaning. I know a lot of people may just place their stop loss and take profit orders in places that they feel is achievable. Take profits as such and stop losses maybe at areas of interest, but for me, my placement of these orders are very specific and very strategic. And I'm going to go through where I would place my stop loss and take profit orders on some positions that we may look to place in the future. So if we just head over to the NAS example, if you've just watched the previous, part 1 of this episode, you'll understand that I placed my stop loss below this zone here because the low that was created here at this zone was considered protected. So setting our stop loss here almost guarantees that it's not going to be hit on the off chance that price does actually go on to create the structure we want to see. Now, to elaborate on that, if we just draw a bearish market, if we are looking to get involved in this bearish market, we should be placing our stop loss above these highs because these highs are considered protected. Now, yes, price can break structure to the upside and start trading us in a bullish way. That's absolutely a possibility. But placing our stop losses above these protected highs are the safest bet because in realistic terms, if we are to follow the laws of bearish structure, these highs that are being set in the market shouldn't break. What we do see, however, is a break in the lows that are created to create new lower lows. So this takes us to our take profits. Well, our take profits should be set just above the previous low. And this is to guarantee that our take profit can be achieved. Now, looking at a bullish example, the opposite applies. So in bullish structure, we break the highs and we protect the lows, right? So if we're getting involved in buy positions, we should be setting our stop loss orders just below the last low or just below the low that we get involved from because they are seen as protected. And our take profit should be set at the previous high. Why? Because this high should break to create a new higher high. So by setting our take profit just below this, it guarantees that our take profit is achievable. Now that is just to cover that very quickly. To go into more depth, just so you guys get a better understanding as to why we set them in these areas, is because for example, if we get involved in a bearish position here, okay, this is what the position would look like in my eyes. So I'd get involved here, my stop loss would be set just above the high that's been created, my take profit would be set just above the last low. This gives us a 1 to 3 risk to reward ratio. That's amazing. That's a good returns from a position. Now, let's just say that price traded down, but then actually decided to correct itself to go on to create a new high, breaking this high here. We don't want to be in short positions in this market if price is going to trade above this. Why? Because if price trades above this high here, that tells us that we are no longer following the laws of bearish structure, and we are probably looking at following the laws of bullishness. Why? Because in bullish structure, we break the highs, okay? So by breaking this high here, we are getting the confirmation that price is no longer following the trend we are wanting to be a part of. So we don't want to be in the position anyway. Now, the same applies for bullish opportunities. So if price was trading in a bullish way, and we got involved in a bullish position, as we would at the end of a correction and the start of the impulse. Let's just say that we got involved here, setting our stop loss just below and our take profit just below the last high. We can see here that we walk away with a 1 to 2 in this trade. Now, again, if price was to actually go on and create a low that came lower than the last one, we are breaking structure to the downside. What happens in bearish structure? We break the lows and we protect the highs. This is suggesting that price is now following the laws of bearish structure. So why would we want to be in a bullish position trading up when the market is going down? We don't. So this is why we set our stop loss underneath protected lows in bullish structure and above protected highs in bearish structure. Now, when it comes to the take profits, our take profit was obviously set for this position, let's say, just here. And the reason for this is because we want to guarantee that our take profit can be achieved. Now, how can we guarantee that our take profit is achievable? We guarantee that our take profit is achievable if we set it just below, just above the last low in a bearish structure. Why? Because in bearish structure, we break the lows and we protect the highs. So by setting our take profit just above the last low, it guarantees that price should hit take profit, because price realistically should go on to create a lower low. The same applies in bullish structure. We should place our take profit just below the last high. Why? Because in bullish structure, we break the highs to create new higher highs. So realistically, the high that we have set our take profit at should break to create a new higher high. So this is why I place my stop losses and take profit orders in the places that I do. And I would suggest to you guys to follow the same. You're going to see a massive positive impact in the trades that you are placing if you follow these steps here. Now, when you come to understand structure within structure, the fractal nature of a structure, you'll actually be able to stretch your take profits further. And I'm going to show you an example of this. So let's just say this is a bearish trend trading us lower, right? We want to get involved in a short position in this market. The ideal place would be here to get involved in a short position. So what we would do is we would look at the fractal structure of the market. So we would see that it's trading in a bullish way. Price then breaks structure to the downside, as you can see here. We then get involved in short positions here at the first lower high that is created. If you watch the first section of this video, you'll understand my thought process when it comes to breaks of structure and what follows after a break of structure. So the first correction follows, followed by the next impulsive wave. And then we should see a continuation in bearishness trading us lower, right? So if we can get involved fractally at this point here, we are able to refine our stop loss to this protected high that's here, but we are able to stretch our take profit to the higher time frame one, which is here. So you can see we then stretch our take profit, allowing us to have a greater risk to reward return, and as a result, we generate more from the position that we are placing. If we were to follow that same strategy and that same steps that I gave you just a second ago, we would probably set our take profit here because we would want to set it at the last low, right? If we use our knowledge of going down in time frames, and we are then able, and we understand the bigger picture and what should take place, we are then able to stretch our take profit exponentially and take full advantage of the higher time frame structure. And placing our take profit here is still more than achievable because this is a bearish market, but it provides us with a larger swing. So if you're someone that's not familiar with structure within structure, the fractal nature of structure, we've got videos on it on our channel. Go and check them out. They are going to allow you to generate great returns on the positions you're placing. An example of this is here. You can see that this is a 1 to 28 trade. So if you're risking 1% of your equity, there was a possible chance of you making 28% from this one trade, which is amazing. Me personally, I didn't take home that much. I think I took maybe 6 or 7%, and this was because I took partials throughout, which leads nicely onto our next point. So you can see here that this market is obviously traded us in a bullish way, and we've taken profit. This is a brilliant position. We had all the confirmation parameters we needed in order to execute the position. But a step that I always follow and something that I always put in place is taking partials and trailing my stop loss. So partial taking is very important as it guarantees a return on our investments and a return on our trades that we're placing, and it also alleviates risk. So if you're risking 1% of your equity, a trade is in 3 RR, so 3% profit. If you took a 50% partial, you are banking 1.5% because that's 50% of 3%. Yeah. What also happens is you are now only risking 0.5%. Why? Because we've closed 50% of the trade, and the trade was only 1%. So not only have we banked 1.5%, but we're now only risking 0.5%. So worst case scenario, if our stop loss was to be hit here, we would still walk away with 1% profit. Why? Because we had 0.5 running and we had 1.5% profit that we had closed off. So 0.5 take away 1.5 is obviously 1%. Now another thing that we can put in place is moving stop loss to entry. By doing this, it then increases our take home profits to 1.5%. Now let's just say that price continues to trade and take us to 10 RR, okay? So we make 10 RR from the position. It's a 10 RR trade and take profit is achieved. Yes, we closed at 3 RR for 1.5%, but the rest of our 0.5 trade hit 10 RR. So we made 5 RR, that's 0.5 times 10, which is 5 RR. So we made 5 RR from the 0.5 that was left open, and then we made 1.5 at the start. So we walk home with 6.5% from this trade. So yes, we might not be walking home with 10 RR, which is 10%, but we are still walking home with a very nice amount. But on top of that, we are putting safety precautions in place to ensure that we are minimizing any losses in the markets and maximizing those profits. So that's just a quick look on taking partials. Now to touch base on trailing stop losses. So you can see here that we've had the introduction of highs and lows, right? Now for this position, I trailed my stop loss twice. My first trail was here and my second one was here. Why? This was my first because this low that was set went on to set a new high, as you can see here. This high came higher than the last one. So this was clear bullish structure. We had a low, followed by a high, followed by a higher low, followed by a higher high. So I understood at this moment in time, this was the last protected low. And realistically, price shouldn't come to traders lower than this low because we are following the laws of bullishness. Now, on the off chance that price does trade us beneath this low, that tells me that this market is no longer following the laws of bullishness anyway, and we can expect further bearish structure. Therefore, we don't want to be in this position. So by trailing our stop loss here, we are maximizing the profits and the returns that we can make while still being safe in the trade that we have placed, because only when we get confirmation that price is no longer following the laws of bullishness do we then exit the market. So we are waiting for confirmation that price is no longer following the laws of bullishness before we actually leave the market and close off our positions. So this is why it's important to always trail your stop losses when you are taking part in the market like this. Now, again, the same follows here because this high created this low and this low created a new higher high. Therefore, this was the last protected low. If price was to trade beneath that, that tells us that price is no longer following the laws of bullishness, and we should look at closing those positions. So I trailed for the last time at this point here. Now, as you can see, price actually went on to take profit, which was great. So by applying those SL moves and trailing our stop loss, we were safe. We didn't get closed out before a continuation in bullishness. We put the right safety measures in place to maximize the profits and the returns that we could generate in case of a reversal, and we minimized any risk. So that's why it's important to trail your stop losses, whether it's in a bullish or bearish position. The same obviously applies in a bearish market, but we would just be trailing them above the new protected highs that are created within the bearish structure. Okay, so now moving over to reassessment of market conditions. This is basically just something you guys should take into account when you obviously create your trading strategy and you create your trading plan. When you follow a trading strategy and you follow the trading plan that you've created, what you've got to understand is that market conditions change. There are phases within the markets that take place throughout the year. Now, we need to be flexible and we need to be able to adapt to the changing trends. We need to understand that there are going to be times where the market is going to range. There are going to be times where the market is within a consolidating phase. It's either distributing, accumulating in prep for a move to the up or downside. And there's going to be times where it's trending and it's trending in a clear direction and we can take part in the market. So by being flexible and being able to adapt to the market conditions, we are then able to ensure that we are profitable all year round, because there are times, I'll be completely honest with you, where the markets are very difficult to trade based on the rules that I follow and the things that I have in place, and that's just because not always are the markets trading in a trend. There are times where price is consolidating within a range, and this is because it's in preparation for a big move to the up or downside, and we need to take accountability and understand that phases like this happen, and when phases like this do happen, we need to put the right precautions in place. So for me personally, there's nothing I need to even type in on here. What you need to do is you just need to sit patiently and wait for the opportunities to arise. Don't force positions to work if the markets aren't playing out as they need to in order for you to actually execute the trades. A mistake I made when I first started was I would try and force positions and I would try and force analysis. I would try and force things to make sense. And as the years went on and I became more patient with myself and the mindset that I had, I realized that in actual fact, it's all right to not place a position. It's all right to not trade for a week. It's all right to not trade for 2 weeks. It's all right to not trade for a month. If the conditions of the market aren't giving you opportunities that are screaming out to you, that's okay. There is no point forcing a position because the likelihood of you being profitable is very, very slim. I only place positions in the forex markets if a position is screaming out to me and it follows every single rule that I have listed on here. Now, when you can achieve that and when you can be strict with yourself and sit on your hands and be patient, this is when you'll notice a huge shift in how successful you are in this industry. So something to take away from this is to regularly reassess the market conditions and how you trade accordingly to that. Now, just to finish off on news and events as well as exit based on strategy rules. News and events, it's quite simple. When it comes to fundamental analysis, if you watch the entry criteria, you'll understand that we won't place positions, or I don't place positions anyway, unless there is no fundamentals or there is nothing that can impact the position I'm placing. So if I wanted to place, I don't know, a long on a US dollar pair, but I knew that the NFP was going to come out at 1:30 on the Friday, I would not place that position until the NFP results have come through. And the reason for this is because a huge amount of volume is introduced into all US dollar pairs, and we see huge shifts in the markets on these news releases. Now, we could have the best setup and price could be playing out perfectly, but as soon as fundamentals come out like that, it can take a massive shift in our position and we can see slippage take place and we can be taken out in the markets. Slippage is basically where your stop loss is jumped over. So you could have your stop loss placed below a protected low and price could trade through that, slip underneath your stop loss and continue to trade lower, meaning that your stop loss hasn't been hit and you're then at higher risk of losing more than your set risk percentage. So for me personally, if there is news and events in the coming hours, I will either close my positions prior to the news results, or I will wait till after the news has been released, the news events have been released and the results have been released, before I place any of the positions I'm wanting to. So if you are wanting to take part in the markets, just ensure that there is nothing that is going to jeopardize the positions you are placing. And if there is something that is due out in the coming hours, put precautions in place and look at closing the positions beforehand, just to ensure your safety with the position you're placing. Now, I'm not going to sit here and say I've never traded through fundamentals, because I have. I've traded through the NFP, and I've traded through multiple pieces of fundamental news over the years, but that is only when a position is so far in profit that a shift to the down or upside would clear me of hitting stop loss at entry point. So I would only hold a position if it was, say, 50, 60, 70 pips in profit. I knew that I had enough room to breathe. If fundamentals was to hit, I still had time to close a position if it went in the wrong direction. And there is less likelihood of slippage, because when we see these spikes initially, price quickly calms down and just trades with high volume to one side. So if you are going to trade through fundamentals, just ensure that your position is in far enough of a profit that it's not going to have an impact on the position you place in. So just to round that whole topic up, monitor economic calendars for upcoming events so you stay tuned with what's going on, and consider exiting or adjusting positions before high impact news is released. Now, exit based on strategy rules. Well, we've kind of covered that topic with trailing stop losses and what we would do when it comes to monitoring and managing a running position. So obviously I trail my stop loss with every position I place, and I put it under protected lows and above protected highs. That is just something I have always done, I've always followed. This just ensures that I am maximizing profits and minimizing those losses. If you want to follow a different strategy when it comes to managing positions, then absolutely do so. But once you have found something, I would recommend sticking to it, because if you are chopping and changing depending on positions, you are going to see that inconsistency. And when you see that inconsistency, that is when you see negative impacts on the positions you're placing, but also the psychology as well, because you have no set strategy or plan when it comes to your exit based on the rules that you have in place. So find something that works for you. I use trailing stop losses and I take partials throughout my trade. And then once you have found something that works, stick to it, regardless of the position you've placed and regardless of the outcome of the trade. Okay, so I've listed 3 things here that I want you guys to take away from this video. So we've got always trail your stop loss above or below protected highs and lows in the market. That's a no-brainer. Trailing your stop losses and partial taking when managing trades. So ensure that you're partial taking and trailing your stop loss. And then finally, closing positions early before fundamental news, or put safety measures in place if you do plan on holding through those fundamentals. So always monitor the economic calendars for upcoming news and stay in touch with the fundamental side of things, as they will impact the trades that you are placing. So those are 3 points that I want you guys to take away from this video and that I feel will benefit you when it comes to trading the Forex markets and setting yourself up for this trading plan. Now that's actually going to conclude this video. This one has been a lot quicker, maybe not so brief, but we've still gone over the strategies that I have in place and the things that I put in place and the things that I would suggest you guys follow. As I said to you guys at the start of the video, if you have any questions or queries regarding this video or the things I've gone through today, please leave them in the comments below. I'm more than happy to reply to comments or create videos based on your queries. And if you guys aren't involved in our VIP services or the Learning Lounge group chat, the link will always be in the description, so get yourself involved in there. This way, you are not missing out on positions like this. Today, I personally took 6-7% away from this position. I had clients in the VIP chat that made huge amounts of money from this trade. So avoid missing out on opportunities like this and get yourself involved in our Learning Lounge group chat. Now, I just want to say a massive thank you for watching, and I'll catch you all in the next episode.